Hello, everyone. Thanks for joining us today. Now, before we dive into our presentation, let's warm up with a little brain teaser, shall we? So, after working hard for his entire life, Bill has decided to retire at 65, and he's going to go to more concerts than ever before. Bill has $42,475 in his taxable income, which includes $25,000 of Social Security benefits. Now, as you can see, Bill's $42,475 income puts him squarely in the 22% tax bracket because it's more than $40,125 and less than $85,525. Toward the end of the year, Bill decides to take a trip to see Willie Nelson in Austin, and he withdraws $1,000 of IRA income. How much is Bill taxed on that extra income? The logical answer is for every dollar of IRA money Bill pulls out, he pays 22 cents in federal income taxes. Therefore, if he took out $1,000, he should owe $220 in federal income tax. That's a 22% tax rate, right? Wrong. He owes $407 in tax. That's a 40.7% federal tax rate on that income. Thanks to the madness that is our tax code and the unique formula that determines how our Social Security benefits are taxed, the real answer is that Bill owes $407 on extra income. That may sound shocking, right? Almost to the point where it can't possibly be true. Again, if the tax rate for a single person is 37%, and that tax rate doesn't begin until he has more than $510,000 of taxable income, how can Bill pay a higher rate with so much less money? It doesn't make any sense, does it? But here's the thing, it doesn't have to. It's the tax code and it's the law. Later, I'll explain more about why Bill faces that tax bill. But for now, the important thing to realize is that when it comes to taxes, the obvious answer is not always the correct answer. Hello, and welcome to our presentation, How Tax Planning Changes Through 4 Stages of Retirement. My name is Jan McCarter with Jancorp Funding. I've been working with people in this field for a few years, and I've seen a lot of things change through the years when it comes to taxes and planning for taxes during retirement. I found that it's never too late for most people to make changes to make sure they have a better, more comfortable retirement when it comes to their retirement dollars and taxes. I hope that after our presentation today, you'll have a better picture of some of the things you need to consider to make your retirement more enjoyable. I'd also like to mention that assisting me today is Amber, and Amber's going to help out to make sure everything runs smoothly for us on the technical side. I also want to thank you for taking the time to learn more about taxes and retirement, and I want to assure you of one thing about this presentation. I believe you'll be better informed about the challenges of retirement tax planning after listening to this talk. Before we get started, I want to ask each of you some questions. First, what's keeping you up at night? And what made you sign up for this webinar? I mean, most of you probably aren't as excited about the subjects as taxes as I am, right? And yet here you are. So I bet there is a specific reason for it. Are you frustrated that taxes are cutting into your hard-earned retirement funds? Do you fear outliving your money? Are you concerned about the high cost of healthcare in the future? Or maybe you're just trying to make sense of some of the best practices for your retirement. I'm doing this presentation because I've seen many people make mistakes and pay more taxes in their retirement years than is necessary. When that happens, it makes my job harder because people have less income in retirement and we have to find ways to make their portfolios last. So let's take a second to explain how this presentation will unfold. This presentation is organized into 4 key parts. Each key part will build on the previous one to form a solution to our presentation problem, as you'll see. By the end of this webinar, I want you to feel comfortable that you know you are on the right track for retirement, so that you know what questions to ask and what actions you need to take if you're not comfortable. During the presentation and at the end of the presentation, I'll invite you to a taxes retirement planning overview strategy session. This is complimentary one-on-one strategy session that I offer so we can discuss in private the issues raised by this presentation. I'll talk more about that later. We'll be covering a lot today, so hang with us. I want to stress that there's no cost or obligation for the strategy session. I also want to assure you that this is not a sales presentation and you will hear nothing remotely close to a sales pitch. So now there is one other important point I want to be sure to make. Everyone's tax situation is different. You should always consult a qualified professional tax advisor to discuss your specific tax situation, especially about these topics. There's a traditional IRA, and you must pay taxes on this distribution or conversion at ordinary federal and state rates because it's tax deferred. There's the Roth IRA, which is non-deductible. Money grows tax-free and earnings may be withdrawn tax-free in accordance with IRS rules. This presentation references federal taxes, but you may still face state taxes. And once again, check with your tax professional because I do not provide tax advice. What I do is help people understand how the tax code and other rules could impact their financial planning and investments. And then we develop a plan to take into account many of the odd things people encounter, especially around retirement. Our goal here is to help you understand that the retirement distribution game, that's when you're spending more assets in retirement, is much different than the accumulation game when you're saving for retirement. Chances are you've been in the accumulation phase of your life for several decades, and you've been working hard and trying to save money. And hopefully your accounts have grown. And now as you enter or prepare for retirement, you're in an entirely different phase, the distribution phase. And the distribution phase has new strange rules that can catch people off guard. And along with those new rules, there are often many changes in your own personal life that can have a big impact on your taxes as well. For instance, your children may be grown and you have no more tax credits, child tax credits, or your house has been paid off and you have no more mortgage interest deductions. If you're already retired, you may no longer be receiving tax-free employer-paid medical insurance. If you stop working, you may no longer have the ability to stash income in a 401k or similar plan to help you manage your annual tax bill. At some point, you'll start receiving Social Security, and sooner or later, when you reach the age 72, you'll have to start taking out those required distributions or required minimum distributions, RMDs, from your retirement accounts. The list of changes goes on, and many aspects of retirement will affect your tax bill in ways totally different from your working years. Understanding what these are and how they can impact you is absolutely crucial. So that brings us to a simple statement about the problem we're here today to discuss. Simply put, people often pay more taxes in retirement than expected because a confusing system treats various income types differently and contains hidden taxes and penalties. In the accumulation phase, people build their assets in several different ways, like stocks, bonds, real estate, pensions, 401ks, IRAs, and there's even more. In the distribution phase, your regular wages stop coming in. You have to take the money you've saved and use it to fund your retirement, which can go on for decades with good health on your side. That's challenging because you need to make informed decisions about the tax implications of tapping different accounts, and it can be costly. In retirement, your tax rate can vary dramatically based on decisions you make, such as the timing and order in which you use different sources of money to pay for your expenses. Poor choices through misunderstandings or ignorance of the rules can result in people paying more taxes than is necessary. As a result, they may see their savings drop, and that can mean less to leave to the kids and the grandkids. Of course, we don't want that to be you. So we're here today to help you avoid paying more taxes than is necessary. And because you're here, that means you're willing to work towards a solution. Because your tax exposure will change throughout your 4 stages of retirement, you'll need a strategy that anticipates both traditional taxes and possible taxes, surcharges and penalties related to your Social Security, Medicare, and other income expenses. That means you'll need an informed and proactive plan that addresses how you create your income in retirement. My goal is to introduce you to the major aspects of such a strategy and allow you the challenges we all face, and then explain what makes up a workable solution to our retirement tax problem. The first step is to develop an understanding of the taxes you may face. What do I mean by taxes? I'm talking about all the costs that can increase as your income does, including some that aren't actually called a tax. But to me, any cost that goes up as your income rises, it's a tax in my book. You may also need to understand the retirement expenses you'll face, and you'll need to create a strategy that will help you decide which of your assets to tap. First, how much should you be taking from those assets, and when those distributions should occur, because getting this right will help you pay as low a tax rate as possible. Before we go on, here are 4 stages of retirement we'll discuss. Those are rough changes and ranges and descriptions. Your experience may differ from this. This is just a framework for discussing our topic. First, there's pre-retirement, the final work and save years of between 50 and 60 years old. Next, the early years of retirement, between 60 and 70. Those are the go-go years. People often have grand plans for this time, like traveling, volunteering, just all sorts of things. And next, you reach the middle years of retirement, between 70 and 80. And we call those the go-slow years, which bring some financial decisions, such as how to deal with required minimum distributions from your IRAs and other retirement accounts. Finally, there's the later years of retirement, when your health may not be as good and you're thinking about your legacy and estate, the no-go years, as we call them, starting around age 80. As you will see, there are a wide range of issues that must be planned for in each phase, and this can be a lot harder than it seems because retirement is full of surprises. And even the best planning will divert from reality at some point. One future unknown is inflation. People tend to view their future costs in current dollars and don't always anticipate how those costs grow with inflation. Stop and think back about 30 years. What was the cost of milk or a gallon of gas then? Now think about those costs today. and what they'll grow to over the next 30 years when you're not working. That's inflation. Or how about your longevity? Many people end up living far longer than expected, and that requires more money at a time when it's difficult to work. How long do you think you will live? Many people also underestimate how much money they need to maintain a pre-retirement standard of living. And who wants to see their standard of living drop? And then there's the health care costs. That's the 10,000-pound gorilla in the room. This includes your out-of-pocket payments for services and drugs, plus Medicare and insurance costs, which we all know will continue to rise. Now, at this point, you may be thinking, okay, what's the first thing I need to understand about retirement and taxes? Well, here it is, our first key. You have to know what your after-tax retirement savings picture looks like before retiring. Because a $500,000 401k isn't really $500,000. The government has a claim on part of your money because the taxes were deferred when you put that money in. You have a partner, the federal government, and the government will get their share when you're forced to start your required minimum distributions after you turn 72. Obviously, the higher your tax rate in retirement, the less your account is actually worth. If what you thought to be true about your retirement dollars and taxes turned out not to be true, when would you want to know? Now, I want to note that required minimum distributions were suspended for 2020 as part of the CARE Act. So if you're turning 72 this year, you won't have to worry about your first distribution. But we all hope things will be back to normal by 2021, and your required withdrawals will begin next year. Here's an example. This chart allows you the cumulative after-tax amounts you could expect to receive from a $500,000 IRA earning 6% per year at various tax rates. And as you can see, the lower your tax rate, the more you keep. Simple in theory, but difficult in practice. And by the way, of course, this presentation applies to both pre-retirees and retirees. So don't worry if you've already started your retirement. Tax planning is important throughout your retirement. Now you may be thinking, okay, my accounts may not be worth as much as I thought, but I'll have a steady flow of benefits from Social Security to supplement my income, and I'll have Medicare to pay my health costs. But one thing you need to understand when creating your retirement tax strategy is Social Security and Medicare have their own tax traps. Let's go back to Bill from our tax brain teaser. We want to understand why he paid so much money from his IRA to go to a concert to see Willie Nelson. Remember, Bill has $38,000 of IRA income, which is part of the adjusted gross income of $56,525, and he has $25,000 of Social Security benefits, and that puts him squarely in the 22% bracket. And he takes a standard deduction. Yet when he took that extra $1,000 IRA distribution, he got hit with a nearly 41% marginal tax rate. or $407 on that $1,000. Let's break that down, how this actually happened. First, let's remember that the only difference between our two scenarios here is that Bill has taken an additional $1,000 from his IRA, which you can see on the right-hand column. The after-concert trip column shows he has $39,000 in IRA income. So we see here that by adding that additional $1,000 of actual income, it increased both his AGI and his taxable income by $1,850. That means for every dollar of income Bill actually received, he's being taxed at $1.85. Huh? How did that happen? Here's the deal. Depending on how much other income you have, the amount of your Social Security benefits that are taxable will vary. For instance, if your other income is low enough, all of your Social Security benefits will be income tax-free at the federal level. On the other hand, if your income is high enough, up to 85% of your Social Security benefits can be taxable at whatever your personal rate is. Bill finds himself in the latter scenario. At his current income after the concert trip, for every dollar that he takes out of his IRA, he now only adds $1 of IRA money to his taxable income, but he must also add an additional 85 cents of taxable Social Security benefits. Now, if you add all that up, that's $1.85 taxable at his 22% rate. An additional IRA income that he actually receives. So if you do the math on that, it comes out to 40.7% tax rate on the additional $1,000. That's the so-called Social Security tax torpedo. It can impact in single filers and married couples with the most fairly modest income during any stage of retirement. It's one reason that planning for tax in retirement is important. Now, you've already come up with a question or two. So remember, there's no cost or obligation for scheduling a strategy session to talk more about your personal situation. Let's look at another aspect of Social Security and taxation and how people approach retirement. Now, during the go-go years, some people retire altogether, but other people enter into a sort of semi-retirement with fewer hours, or others use semi-retirement to do a passion-driven job, or they may volunteer. And working in retirement can impact your planning and taxes in a number of ways, some good, some bad, and some just downright ugly. Let's look at how working during those years can be a good thing. Chances are you have already researched what your Social Security benefit might be at various ages, but you may not know that your Social Security benefit is calculated using your highest 35 years of earnings. Well, if you started working late in life, what if you left work to raise children? You may not have 35 years of earnings history. Sometimes you'll have only 28 years. Those remaining 7 years count as a big fat zero. But there's good news. Earnings at any age can help you increase your Social Security benefit. And thanks to how Social Security calculates benefits, replacing several years of zeros and even modest earnings can positively impact your benefits. Now let's look at working during your go-go years. It can be somewhat bad if you're already collecting benefits and unaware of the Social Security earnings limit that applies prior to reaching your full retirement age. Here's how that rule works. If you start Social Security, be it on your own retirement or spousal benefits, prior to the year you reach your full retirement age, for every $2 above a certain amount that you earn, which is $18,240 for this year, 2020, Social Security will withhold $1 of benefits. Keep in mind that we're talking about earnings here, like a W-2 salary, self-employment income, but we're not talking about pensions, interest, dividends, and capital gains. They don't count, and they won't reduce early Social Security benefits. For instance, let's say you owe $20,240 in 2020. That's $2,000 over the limit. Therefore, under the $1 withheld for $2 earnings rule, Social Security would withhold $1,000 of your 2020 benefits. But these benefits are not truly lost. When you turn full retirement age, your benefit will be adjusted to make it as if you had applied at full retirement age with respect to those benefits withheld. In other words, your benefit going forward will be a bit higher. Also, in the year you reach full benefit or retirement age, there's a separate higher earnings limit. Okay, we've talked about the good and the bad, so now let's get to the ugly. We're here today to talk about taxes in retirement, but there are other taxes that you may face too. For instance, while you're working, you're subject to the 7.65% Social Security and Medicare taxes. In addition to Social Security and Medicare taxes, in addition to your already income tax. But if you're self-employed, you will pay twice that amount, 15.3%, to cover the employer's contribution. Now, these taxes don't go away. If you're working past your full retirement age, or even if you're collecting Social Security, worse, if your go-go earnings don't make it into the 35 years, those Social Security taxes go into the trust fund and don't increase your benefit. Now let's take a look at how Medicare and something it calls IRMA can impact some couples in the go-go years and beyond. First, what is IRMA?
I didn't get that. Try pressing above to edit.
It stands for Income-Related Monthly Adjustment Amount. The emphasis is on income payment because it is a monthly tiered surcharge, again, the kind of a tax that is taxed onto people's Medicare Parts B and D premiums. But it only happens if you have income over $87,000 for singles and $174,000 for married couples. Let's take a look at what this means in action. Meet George and Martha. They are a high-earning married couple, and both are Medicare Part B and D participants. IRMA surcharges affect income from 2 years prior, and this couple was on track for $271,000 of modified adjusted gross income for MAGI in 2018. But on December 1, George decided to sell a stock he bought for $10,000 on July 1, 2017, and he sold the stock for $11,000. The resulting $1,000 of gain was taxed at the 15% long-term capital gains rate, plus an additional 3.8% net investment income surtax for a total federal bill of 18.8%. That 3.8% investment income surtax is another tax that comes into play when your MAGI exceeds $200,000 for singles and $250,000 for married couples. So George and Martha owe $188 of tax on the gain from their sale of the stock, right? 18.8% of $1,000. Or do they? Remember, my definition of a tax is any cost that increases as your income increases. So then George and Martha will owe more tax than $188 because the gain from the sale of stock pushed them off the Medicare IRMA cliff into paying higher Medicare premiums. Let's take a look. Look at the Part B chart, IRMA chart. That extra $1,000 gain pushed their AGI into the next premium tier that starts with $272,001. So now instead of owing $289.20 each for their monthly Medicare Part B premiums, George and Martha will each owe $376 per month, an extra $86.80 per month times 2, or $173.60, for an annual total in Part B premiums of $2,083. But it's not over. Because Medicare Part D IRMA charges are also impacted, George and Martha will each owe about $19 per month for their drug plans, an extra $461 for the couple over the course of a year. Adding all the IRMA surcharges together for the year, George and Martha will each owe about an extra $100 a month, or about $2,500 for the year. Now combine that amount with the $188 of actual federal income tax they would owe on their stock sale, and the total tax owed on their $1,000 of gain comes to $2,732. And that's a tax rate, a real tax rate of 273%. I want to repeat that's an actual real tax rate of $273. You see, being pushed into a higher Medicare Part B and D premium range is a lot worse than being pushed into a higher tax bracket. That's because if you go over a regular tax bracket by even a single dollar, only those last dollars are taxed at the highest rate. But if you go over the Medicare Part B and D income levels by even a single dollar, you move into the next premium tier. It doesn't matter if you exceed the limit by $1 or $10,000. That's what they call the IRMA cliff. Keep in mind your IRMA payments aren't determined by how much money you made the previous year, but rather your MAGI from 2 years ago. It's another tax thing that catches people by surprise and needs planning. Making sure that you enroll in Medicare at the right time is another critical decision. If you mess this up, you'll get hit by a lifelong penalty. Once again, if you mess this up by enrolling at the wrong time in Medicare, you will be hit with a tax penalty, and it's lifelong. To help you understand further, meet Jim and Ann, both 68. Jim retired at 65 and Ann retired at 66. Prior to her retirement, the couple had health insurance through Ann's employer, and they continued that insurance after Ann retired because her employer offers retiree health benefits. Unfortunately, they didn't know that they had to enroll in Medicare Part B as soon as they retired. Even though Ann's employer offers retiree health benefits, those benefits are generally paid secondary to Medicare after retirement. But Jim and Ann didn't realize that mistake until it was too late, And thanks to the way Medicare enrollment periods work, they weren't able to begin coverage until the next year. In a worst case scenario, this might have resulted in a gap in coverage for Jim and Ann if they had a major medical need. But even in a best case scenario, because Jim and Ann missed their deadline to sign up for Medicare Part B, they will each owe a 10% Medicare Part B base premium penalty for life. You can see how much that translates into real dollars. They owe $347 extra in 2020, and historically we can estimate that premiums will be higher. So that penalty will grow and grow. Over the course of a lifetime, that can translate into a $10,000 mistake. For simplicity's sake, we're assuming that Ann's retiree health insurance covers prescription drugs, so they don't have to sign up for Part D. But just to be sure, there's a penalty with signing up late for Part D as well. We've seen how Social Security and Medicaid have their own tax traps and unique rules and penalties. So if you're like some who've seen this presentation, you may be asking yourself, well, are there any other tax traps? Well, the rest of what we'll cover isn't like what we've seen with the Social Security tax torpedo or the Medicare Irma cliff. The public generally isn't aware of those tax squeezes. What we're going to see now is how the tax code in plain view snags retirees, especially when there's no planning. You must plan how and when you use taxable, tax-deferred, and tax-free assets to manage your income and tax brackets efficiently. You can't be haphazard about tapping your tax-deferred savings. Timing is everything, and if you don't plan carefully through all stages of retirement, you'll encounter unintended tax consequences. Let's take a look by first addressing a question I hear often when doing retirement planning. Which account should we spend first? Here's a common example. Sam and Mary have been good savers, as you can see, and we're looking forward to spending their retirement years traveling and seeing their grandkids. In addition to Social Security, they have $450,000 each in an IRA, $60,000 each in a Roth IRA, and $300,000 in a joint bank account. They want to spend about $8,500 a month, which is over $100,000 a year. So if you were them, where would you take money from first? Conventional wisdom says first take the after-tax money in the bank. Then take the tax-deferred IRA money, and then take the tax-free Roth money last. This is conventional wisdom. It's been promoted by many big investment firms for some time. It's not a bad plan, but we know conventional wisdom isn't always the best approach. Not surprisingly, this has drawn the attention of academic researchers specializing in financial planning. The research has shown that the conventional wisdom approach probably isn't ideal. Here is an alternative approach. There are two key elements in the early years. First, use the taxable bank money for expenses. Also, during the same period, accelerate IRA distributions during otherwise low-income years, putting that money into Roth accounts. This is the filling your tax bracket approach, which we'll discuss in a second. This alternative approach gives you more flexibility to use that tax-free Roth money strategically in future years. Does it make a big difference? I think so. This approach has been shown to increase portfolio longevity That is how long your non-Social Security assets last before being totally spent, by up to 2 years. The big takeaway here, of course, is that you've got to plan all the way through retirement, especially around how you handle your tax-deferred assets. And of course, once again, please see your tax professional for tax advice. One way to help manage your income both before and during retirement is to utilize Roth IRA conversions. A Roth IRA conversion is a simple process that allows you to move money from an IRA or other pre-tax retirement accounts, like a 401k or a Roth IRA. In general, the amount you convert is added to your income for the year and will be taxed at your rate. So it's recommended, once again, before making any conversions, consult with your tax professional. A conversion doesn't need to be all or nothing, though. One helpful conversion approach is called filling up the bracket. Often you find yourself in the middle of one of the tax brackets with room to add more income without pushing yourself into a higher bracket. For example, in 2020, the 22% tax bracket for married couples filing a joint return goes from about $80,000 to about $170,000. If you file a joint return and your taxable income is $100,000, that means you could add another $70,000 of income without going into the next bracket. Making a Roth IRA conversion like that could make sense. If you plan to convert a large IRA, this approach is often more tax efficient than converting the full amount in 1 year. Instead, you can make smaller Roth IRA conversions over a number of years, filling up your tax bracket each time. This can help reduce the average tax rate you'll pay on your converted money and also spreads the tax bill out over a longer period. Roth IRA conversions can be especially powerful in years when your taxable income is low, such as having a non-recurring medical expense deduction or a low sales year for a business owner. It's also common for people who retire early and not yet receiving Social Security benefits, pension, or IRA distributions. They may have a very low tax bracket, making it a good time to complete Roth IRA conversion in those pre-RMD gap years. So this is a good time to spell out the crux of things. You must know whether you're trying to keep income below a bracket threshold to avoid bumping up to the next highest tax rate, or whether you're trying to increase income to fill up a bracket to take advantage of that tax rate. Some possible tactics you could use in managing income around tax brackets might include withdrawing tax-free money from life insurance policies to keep income low, selling highly appreciated stock for low or no capital gains, or taking distributions from your IRAs or 401ks to take advantage of a lower tax rate. And as we've seen, you can also consider partial Roth conversions to fill up lower tax brackets. Now, there are some other pre-retirement strategies that you might consider, but since they don't apply to all people, we'll move on. We all know that charity begins at home. So it's a natural question to ask, how does tax retirement planning figure in? It's a very good question because the government wants their share of those tax-deferred assets when you pass away. And like we see, how you set things up really matters, which leads us to our final key number 4. Organizing your assets for your family's benefit. Estate planning still matters. Estate planning is always a relevant topic, even though people don't like to discuss death. We're going to discuss it in a traditional way, though. That's because new tax law excludes estates valued up to $11.4 million. from the federal estate tax, meaning only the teeniest fraction of people need to worry about estate taxes. Still, very important tax issues remain around how your assets are received by your beneficiaries after you die. One example is making sure married couples plan for their available step-up in basis. That's quite a tax term, right? Simply put, a step-up in basis is a tax rule that readjusts the value of an inherited asset so the value is not what your spouse or decedent paid for it initially. Instead, it's stepped up to its price for the date of death. This can make a big difference, as we'll see. It's likely that most assets you own, other than your retirement accounts and annuities, will be eligible for a step-up in basis. Let's consider the couple Phil and Mary. They're married and own a variety of taxable investments in a joint account known as joint tenants with rights of survivorship. One day, they have bad news. Phil is diagnosed with terminal cancer and he has 18 months to live. Let's see how that works with two scenarios. In the first case, Phil and Mary make no planning changes to their assets. When Phil dies, Mary will receive a step-up in basis on Phil's half of the joint account, which is $60,000. She'll still face a future $60,000 of unrealized gain on her half of the account. Simply put, that means if Mary decides to sell all the assets, she'll owe tax on her $60,000. Now, suppose that upon Phil's diagnosis, Mary and Phil move all the investments into one account in Phil's name. Then, as long as Phil lives longer than 1 year, Mary will receive a full step-up in basis on the entire $120,000 account. Simply put, Mary could sell that account and pay no tax. When you sell your investments, would you rather owe $60,000 of gain or none? And let me say, planning around death is hard. And this is where a professional can help because they're emotionally removed from the situation and can assist you to make good decisions that may seem hard at the time. Let's talk a little bit about long-term care. This topic is becoming more and more of a concern for retirees, and for good reason. Now, this is not a long-term care presentation. It's about retirement and taxes. But believe it or not, there are a number of tax breaks associated with long-term care insurance. For instance, long-term care premiums may be a deductible medical expense at the federal level. And on the other side, if you're receiving long-term care benefits, in many cases, those benefits are tax-free. In addition, cash benefit style policies are tax-free if they don't exceed the higher of your actual long-term care costs. And for IRS, the daily limit is currently $380. Choosing how you pay for long-term care costs can have a big impact on your estate and your heirs. In recent years, non-traditional long-term care policies that blend together some long-term care insurance have become popular. Often the first inclination of the insured here is to tap the policy to pay for long-term care costs, but that's often a tax mistake. Let's look at Florence, a widowed woman who qualifies for long-term care benefit and lives at home with in-home care. Her yearly care costs are $60,000. Florence's Social Security benefit is $20,000 annually, which covers tier basis expenses, but not her long-term care costs. She also has $400,000 in an IRA account and a life insurance policy with a long-term care rider that will pay $500,000 to Florence's children upon her death. Alternatively, Florence could use up to $10,000 per month of her death benefit for long-term care costs. Now, any amount used for long-term care costs will reduce the life insurance death benefit. This is just an example, and it's not representative of all policies. But many long-term care insurance policies, hybrid policies, work this way. First, suppose that Florence is infirm for 5 years and uses her policy to pay for long-term care expenses. That's why she bought it, right? Here, Florence pays little or no income tax during this period because she'll have such large unreimbursed medical expense deductions. The $500,000 life insurance policy pays out $300,000 and $60,000 per year for 5 years. That means her kids will inherit tax-free life insurance of $200,000, which is the remainder of the $500,000 policy value. In addition, her children will receive the $400,000 in her IRA, which will be taxable to them at that time. Now let's suppose Florence lives for the same 5 years but uses her IRA money to pay for the long-term care expenses instead. Florence still pays minimum income tax per year because of her high medical expense deduction. But now the kids will inherit $500,000 of the life insurance completely tax-free, as well as roughly $100,000 of remaining IRA money, which will be taxable. Comparing the scenarios, the ultimate net benefit is unknown because it depends on Florence's children's tax rates. But it's hard to imagine a scenario where paying for her care with $300,000 of taxable money with minimal cost to Florence is not a better option than paying for her care with $300,000 of tax-free money. In the second scenario, we're preserving the tax-free money for the heirs and paying for the long-term care with Florence's taxable IRA money. Okay, we're toward the end, and you're probably thinking, goodness, how in the world will we ever manage this? It's a good question, and let's bring it all together now. We started with a clear statement about the problem. Retirees often pay more taxes than expected because a confusing system treats various income types differently. Let's do a quick review of what we've learned about the 4 stages of retirement. Under the pre-retirement heading, we saw the importance of understanding the after-tax value of your retirement savings before you retire. And we also saw that the pre-retirement years, it's critical to consider your tax-deferred savings and start taking advantage of funding Roth accounts to fill your brackets, something you do through your early retirement years in low tax years. We also looked at Social Security and taxes, and we saw Medicare has its own tax-like structure that can push you off the IRMA cliff. And we saw the importance of signing on for Medicare on time, right in the middle of those early go-go years. That's because starting in your middle retirement years, you'll be confronted with required distributions, and we've seen the importance of planning your income needs before then and the tax issues involved. We then saw the importance of setting up your assets and managing them during the later years of retirement so that you can preserve the most for your heirs and leave them with the most tax flexibility. All those items lead us to the obvious solution from our original problem. Because your tax exposure will change throughout retirement, you need a strategy that will anticipate how and when you tap your assets to cover your personal expenses, understand the range of taxes you will face at various stages, and manage your actions so that you can pay as low a tax rate as possible. By attending this presentation, you're indicating that you're preparing to leave the accumulation phase and moving to the distribution phase when you start spending retirement assets. We see that the distribution phase is more complicated than working and collecting a paycheck. Managing your tax rate through the 4 stages of retirement is part of the challenge of retirement planning, and we've seen the costs of mistakes. Naturally, we want to be efficient with our savings, and there are strategies to reduce your tax burden. But as many things in life, this takes education and planning. It's a lot to think about. Our tax code is complex, and the rules continue to change. But that doesn't change that you will need a plan. I hope you've learned a lot during this presentation about how tax planning changes through your fourth stage of retirement. We've taken a lot of time out of your day today. Thank you for hanging in. And I'd like to help you get started with creating a retirement tax planning strategy. Because of your commitment, I'm inviting you again to schedule a 15 to 30-minute strategy session with me at no cost or obligation. This session will help you better understand where you need to be and what you need to plan for. We will identify where you and your family stand in regard to preparing for retirement. We'll review your timeline and identify key retirement and savings needs and the roles taxes play. I want to help you prevent from making mistakes. We want you to be prepared and organized for this aspect of your life so that you and your family can have peace of mind. So if you haven't already done so, please go ahead and schedule a strategy session. We are at the end of our time. I want to thank Amy for her assistance, Amber for her assistance. She's done a great job today. And once again, I'd like to really thank you for attending this presentation. So go out and make it a great day and stay safe.